Your mortgage payment this month is £1,461. £420 of that buys your house. The other 1,042 is rent. On money, not on the property, on the money. Run that forward. 10 years in, 120 payments, never missed. You have handed over £175,000. And you still owe £184,000. You have paid more than you have cleared. Over the full 25 years, the interest alone comes to £188,000. That is a second house. You just don't get to live in it. Most people assume that's just what a mortgage is. It isn't. It's one specific structure, and there are 3 others that are used every day by Islamic banks in Britain, America, and the Gulf. In the next 12 minutes, why the conventional mortgage is shaped the way it is, what the 3 halal alternatives actually do differently, Murabaha, Ijara, and Diminishing Musharaka, and the 4 questions that separate a genuine Islamic mortgage from a conventional loan wearing Arabic vocabulary. Here's the part that gets skipped. When you take a conventional mortgage, the bank does not buy you a house. The bank lends you cash. You buy the house. The bank takes a legal charge over it as security. That distinction is everything. The bank never owns the property. It never carries the risk of owning it. If the roof fails, that's yours. If the market collapses, that's yours. If the building burns down uninsured, you still owe every penny. What the bank owns is a claim on you. And that claim grows at a fixed percentage, guaranteed, regardless of what happens to the asset. Or to you. Money lent, more money back. No ownership and no risk taken in between. That is the definition. Not the marketing, the mechanism. Now watch how it's sequenced. Interest is charged on what you still owe. At the start, you owe almost everything, so almost everything you pay is interest. In year 1, £17,500 leaves your account. 12,300 of it is interest. 71%. You are not really buying a house in year 1. You are renting the money to buy it later. The crossover. The first month where more of your payment goes to the house than to the bank doesn't arrive until year 13. Half the term. And that's if rates never move and you never remortgage. Every time you remortgage, the clock resets, and you walk straight back into the front-loaded years again. This is where the Quranic ruling stops being abstract. The verse doesn't forbid profit. It permits trade and forbids riba in the same breath, in the same sentence. So the line isn't between making money and not making money. It's between 2 ways of making it. In trade, you own something. You carry the risk of owning it, and you profit if it goes well. In riba, you part with money. You carry no risk at all, and your return is guaranteed in advance. Ownership and risk. Hold on to these 2 words, because every structure in the next half of this video is an attempt to put them back into the transaction. Structure 1, Murabaha, cost plus sale. The bank buys the property outright. It actually owns it, title, risk, the lot. Then it sells that property on to you at a price that's stated openly, the cost plus an agreed markup. You pay that total in installments over an agreed term. 2 things follow from that. The bank took ownership, however briefly, and with it, the risk. And your price is fixed at signature. £290,000 is £290,000. It cannot grow. There is no compounding because there's no outstanding loan to compound. There's a sale price and a balance remaining on it. The trade-off is rigidity. Fixed price cuts both ways. Settle early and you may not save much, because you owe a price, not an interest-bearing balance. Structure 2. Ijara wa Iqtina, a lease that ends in ownership. Again, the bank buys the property and holds the title. But this time it doesn't sell it to you up front. It leases it to you. You pay rent for the use of an asset that someone else owns, which is an ordinary, permitted transaction. At the end of the term, or progressively along the way, ownership transfers to you. And because the bank holds the title, it holds the obligations that come with it. Structural insurance. Major repairs. The loss if the building is destroyed. Those sit with the owner, not the tenant. That's not a technicality. That's the risk the whole ruling turns on, sitting exactly where it should. The trade-off is that rent can be reviewed. A poorly written ijara lets the bank reprice the rent against a market benchmark. And if that benchmark is just the base rate under a different name, you have recreated the thing you were avoiding. Which brings us to the structure most British and American Islamic banks actually use. Structure 3. Diminishing Musharaka, shared, shrinking partnership. This is what Al Rayyan, Gatehouse and Guidance Residential are built on. You and the bank buy the property together. You put in 10%, the bank puts in 90%. You are co-owners, on the title, in those proportions. Each month you make 2 payments that are deliberately kept separate. The first is rent, but only on the share you don't own yet. The second buys a slice of the bank's share and moves it to your side permanently. And here's the part worth sitting with. As your share grows, the bank's share shrinks, so the rent you owe on it falls, every single month, automatically. Your position improves as time passes, rather than in spite of it. Compare that to the chart from earlier, where you were still underwater at year 10. Ownership is real. It's on the register, and the risk is shared in proportion to it. All 3, side by side. Murabaha gives you certainty, a fixed price you can plan around. Ijara gives you flexibility and puts the ownership burden squarely on the bank. Musharaka gives you a cost that falls as you go, and it's the one most widely available in the West. None of them is automatically the best. They answer different questions. Now the part that matters most. Because not every product marketed as Islamic survives contact with these 4 questions. 1. Does the bank actually take legal title, even for a moment? If it never appears on the register, you have a loan with a different name on the paperwork. 2. Is the profit disclosed and agreed at signing, or does it float against a benchmark? Floating isn't automatically fatal, but if it tracks the base rate exactly, ask what the structure is really doing. 3. If the property is destroyed and uninsured, who takes the loss? If the answer is you entirely, then the bank never took ownership risk, whatever the contract is called. 4. The one almost nobody asks. What happens if you pay late? In a genuine Islamic contract, a late charge cannot become profit for the bank, because profit on delay is exactly riba. It must go to charity, and the bank must be able to show you that it does. Ask them. The answer will tell you more than the brochure ever will. And I'll be honest with you. There are serious scholars who argue some of these products are conventional lending with extra steps. That criticism isn't unreasonable. These 4 questions are how you check a specific offer, instead of trusting a label. So, a conventional mortgage is a loan secured on a house, priced so that 10 years in, you've paid $175,000 and still owe $184,000. Murabaha replaces it with a sale. Ijara replaces it with a lease. Musharaka replaces it with a partnership that shrinks. All 3 put ownership and risk back where the ruling requires them. You don't have to accept the $188,000. You have to know which of the 3 fits your situation. and then ask the 4 questions. If this changed how you read your own mortgage statement, subscribe. A new mechanism decoded every week. Next episode. Whether the savings account you were told was the safe option is quietly doing the same thing to you.